Hello, folks. Welcome back. Just a quick little review here, and I'm going to try to get myself back in sync with the foreign exchange markets. I haven't been watching them, admittedly, for a number of months now. So today's February 17th, 2026, and I'll just briefly take a peek at the daily charts with you here. This is the dollar index, and you find that on TradingView by pulling up the TVC version of it. And it's a mess, as most of the markets are right now. The recent highs, you can see here, we had these taken. This high was taken here and was aggressively sold off, took out that low. And it's at a time and place and price where I could argue either side. And I'd like to tell you when it's like that, I also give you like the gun to my head perspective. Like, what do I think it's likely going to do next? Well, first of all, everybody's waiting on bated breath to see if we're going to be attacking Iran. Okay, I don't think we brought a lot of hardware over there to just show it off. So I think that once that happens, once that goes hot, once the missiles start flying back and forth, um, then obviously that's going to bring some breath into the marketplace. It may not be a good thing, but it's going to hopefully break us out of this gridlock we've been in. So dollar index, we came up into this inefficiency here to get to this breaker. Gun to my head, even though we have recently just taken that low here, I'd like to see it revisit that low. And then if that fails, if we can get above this on a closing basis, then I think that we'll probably want to revisit this. So it's kind of like a wait and see. I'm not trying to position with anything dollar based. I'm trying to get myself back in sync with it. So this is what I'm doing now. These are the ideas I'm holding to at the very moment. It's not something I can take a trade on. It's not something I'm suggesting that you should use for your own analysis for taking a trade on. It's just this is me getting in sync. Okay, so these are the levels I'm watching and what I'm looking for as it pertains to inefficiencies, buy side, sell side, and the range that we're trading within. I favor presently another run lower, but if I'm proven wrong, then obviously we'll take another look at it. I'm only going to ring in the foreign exchange or Forex markets on Tuesdays and Thursdays. So it's not going to be like a steady diet. So don't be frustrated with me and saying, hey, can you talk about this? Can you talk about that? I'm only going to talk about them 2 times a week. Moving on to Euro. Euro, we had a little run above this old high here. Then it quickly gave up the ghost there, which is obviously the opposite of what we just saw on the dollar index. We've taken the sell side here, ran out, took that buy side. And now again, kind of like in similar vein with the exploration to a retest of the low in the dollar, I think that we might see a challenge up to get into this high again. Do we get there and fail above here or just roll over? That remains to be seen. Near term sell side liquidity rests here, buy side is here. I could make a case for both sides. So whether it's bullish or bearish, if I can see both sides potentially panning out, that is not high probability conditions by my definition. So if it's not high probability, then I'm not going to give you a hard line bias. But what I'm looking for is the opposite of what I said on the dollar index. I want to see if it can mount a continuation in the upside, and we'll see if we get that or not. Much in the same vein, we're looking at the pound dollar. We had a high here, took out this sell side, ran up. Sell side is resting below here, and buy side is here. I want to see if the dollar index can trade and retest its old daily low, and that would open the opportunity for cable to run, or pound dollar to run back and challenge this high. It can very well just trade above this old high here and then fail inside this gap if it's going to be bearish. In other words, if it tries to make a run there and fails and falters and goes lower, that could be it. We had this run below here. So it's again 50-50. There are times, obviously, you've seen in the past over the years with me, when I'm one-sided, it's pretty much a 90% strike rate. But if it's low probability like this, where I'm trying to acclimate myself back to the markets that I have been following for over a half a year or so. This is how I start. I grab a daily chart. I'm not interested in looking at anything on the lower time frames because if I can't discern what I think it's going to do on the daily chart, those lower time frames aren't going to talk to me. So identifying the draw, identifying the ebb and flow, and we'll revisit again on Thursday. All right, now we're going to segue into the index futures, and our focus is going to be keeping with managing risk and expectations in the high volatility markets that we have right now. I can't stress it enough. You should be following in a micro contract. Okay. If you're looking at the mini, it's moving too fast. It's too fast. It's moving too quick. It's too far, too sudden, and you don't have the. I'm just going to say it. You don't have what it takes to stay in that and not get beat up. Okay. So drop it down to one micro, weather this first month or two of 2026, see what happens. And I'm confident that as we get closer to the spring months, April, May, I think that that will be a very clean portion of the first half of the year. What we do in the summertime, obviously, remains to be seen. But then I think the fall months again, September, October, November, we'll get back into the clean runs and price action. So I kind of like want to reserve all of my expectations to those times of the year. All right, so here is the continuous contract, as you can see up here. It's not the March contract. This is continuous contract on TradingView, and you'll see that this looks slightly different. But we went up into a premium wick. These are all things I talked about when we were trading here. It would go up there, and we'll look at this portion there in the March contract in a moment. So we're going to go from continuous contract to March delivery contract. So we have the gradient levels here on this wick. You can see how they used it here, upper quadrant, mean threshold, or not mean threshold, consequent encouragement. I'm tired, to be honest with you folks. It is what it is, right? So and I'm not going to edit that out. It drops lower into this suspension block, which we watched real time as it was unfolding, trades up into it here, gives up the ghost, goes lower. We have a small little volume imbalance. It used that for this particular day. And then we create another volume imbalance, which once it traded down into this volume imbalance, came right back up into that, tried several times to make a run above it, failed, dropped lower. And this volume imbalance, if it gives up the ghost on a closing basis, not only am I looking for this sell side as a draw, but this right here, I think, if things get heated in Iran and in the Middle East and all that, with Israel, I think that we'll see our markets trade down here. That's where I'm focusing on the first half of the year. Like that's my target. Now, does that mean it's going to go right from here and go down there? It could, but I want to see what we do with this small gap. Does it stay open? Because it could be a breakaway gap. So basically, what I'm saying is, I'm presently bearish on stock index. Okay, I think that we're going to go lower, more likely to go lower than we are to go higher. Now, moving into the actual March contract. Okay, so you can see that's the March delivery contract for micro NASDAQ. We have the suspension block here. It trades up into the consequent encouragement of that. I mentioned that this inefficiency here with these relative equal highs, that's the draw on the daily chart. And we ran up into that and then gave up the ghost, went into the suspension block, which I told you to look at that on the daily chart, have that annotated. We went lower, came back up into consequent encouragement, volume imbalance, sells off, volume imbalance multiple times in here, like we just saw in the continuous contract. Broke lower. There's a small gap in here. I want to see if does this stay open, because if it stays open and we take that low out, this is breakaway, and we could potentially work down into these lows. Okay, so that's kind of like what I'm comfortable with that opinion right now. But please don't take this as trade advice. It's not meant for you to go out and take risk. Just observe and study. Okay. The markets are extremely volatile right now. They're absolutely disorganized and you can get hurt really, really quickly. So, trading one micro contract in your demo account is what I'm advocating. Okay. Or tape read. Don't even try to do anything else. If you don't listen and you hurt yourself, you did it to yourself. If you make money, I don't want to hear about it. Okay. So, here is the 15-minute contract. I'm sorry, 15-minute time frame on the March delivery contract. And the market left these really strange looking clean highs up here. And as you can see, my alter ego is drawing attention to these here. So if I'm wrong, okay, and we mount a strategic run above this high here, they may want to come back up there and clean that up. But this is a 15-minute buy side and balance sell side efficiency. I was working with my son Karen today, and this is the draw that we had, and it came down and hit it and hit once more after actually sharing it publicly on X. I was commending one of the students who actually was utilizing the same things that Cameron had implemented in his account, which was not a demo account, by the way. So it hits it and rallies back up and got a little disorganized in here, but ended up running higher. And we're going to strip this down into our classic perspective where we go into 7 o'clock in the morning. Okay, so look at 7 o'clock in the morning, go back into the overnight session, relative equal highs. Why is this important? Why is that likely to be a draw? Okay, we'll look at that in a moment. But the market does in fact trade higher, runs up with a juice swing, gives up the ghost, goes lower, market maker sell model down into the 15-minute buy side and balance sell side efficiency. And why did I highlight this? Why didn't it go to the low or make a run below that low here? Because we're inside of a range, a real sloppy range, and it can keep these ranges intact. So I kind of like to use the inefficiencies, and it worked out kind of well today because of the choppy range bound conditions. So for your notes, just keep that in your mind that when we're range bound, if there's inefficiencies, the market will more likely use those and keep price inside the existing range and not trade beyond it. If it does trade beyond it, then it's usually a shift from a high resistance to low resistance liquidity runs. Not all the time, but it can indicate that. So since we're in high resistance liquidity run conditions, look for the range to maintain and trade to the inefficiencies just below the old highs or just above the old lows, as we saw here. Okay. So we're going to take a look at all this here and zoomed in, moved over here 7 o'clock in the morning, Eastern time. We're looking at electronic trading hours, 1 minute contract, a 1 minute time frame on the March delivery contract. It's not continuous now. So the market rallies up, breaks lower, and trades below the original low here or consolidation down into that 15-minute buy side and balance sell side efficiency. Beautiful delivery here and vaults higher to challenge the old highs in here. So we had a discount wick, measure that, consequent encroachment, it hits that. This area in here, I had this noted and I was actually talking about this, and obviously you're not going to be in the conversation, but as I was working with my son, I was indicating how that would be a eventual inversion fair value gap. So without drawing the rectangles on there, moving over here, you can see how it used that with the bodies and then vaulted higher. And again, that's electronic trading hours. So now we're going to go into regular trading hours. And this was the previous regular trading hours settlement price, that closing price right here. And we're going to highlight that. Okay, so that's going to be regular trading hours opening range gap high. Why? Because it opened down here at 9:30, regular trading hours. So that gap here, that is the opening range gap or regular trading hours, RTH, opening range gap. Once we have this, okay, and it opens lower than where it settled previous day, this is a regular trading hours opening range gap low because it's lower than the previous settlement closing price on the previous day. So this is not indicating any of the electronic trading that took place between these two respective times. So now we have that. We can draw our fib from here down to here. I've shared my recent videos where you can see the settings where it has the eighths on it, and you can see that here. So it's quadrants all stripped down. The market trades above it. Look at the bodies respecting the previous settlement. Wicks are allowed to do damage, and then it gives up the ghost and goes lower. You'll see what this rectangle is when we go down to the 15-second time frame. It's there just because it's a nuisance because I didn't remove it. And I'm in there trying to drive you nuts. What have you got this highlighted for? You'll get to it. Just relax. The market trades lower. But this was the first presented fair value gap of the morning here. Okay, it's this buy side and balance, sell side efficiency, which turns into an inversion fair value gap. So it hits lower quadrant, low, and then moves lower. So there's your first presented fair value gap, and it's under the premise of a inversion. Okay, done work up in here and in here, and then dropping down just below that low was enough today. But we're going to take that, scrub on over here, and this guy's got his eye right over here. Look at him, he's watching you. Here's that run up of, and now on the chart that I shared this morning when Cameron was working with his account, I had forced him to use the 24,800 even big figure. So the only thing that was happening was it was being calibrated 2 more ticks higher because it's a big figured level. So you can see how it was sweeping here, 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 and finally gave up the ghost, went lower. Here's your breakaway SIBI, trades up into it there, or you want to call it the model 2022, buy side, shift in market structure, model 2022. Wow, this works on a 15-second chart. Yep, and it moves lower, and then you have smart money reversal, low risk short, first stage distribution, second stage redistribution. There's your unicorn price run, bang, takes off and trades down to that random 15-minute buy side and balance, sell side efficiency. Then comes back up for a return back into that 1-minute discount wick. Consequent encouragement, uses that and trades back down and revisits that 15-minute buy side balance, sell side efficiency. These gradient levels, look at the PM session and look at the Asian session, how it's utilizing these levels here, and you'll find that pretty interesting, I'm sure. And obviously here's the mess that we call the S&P, okay, and we're looking at through the micro. This one, first of all, I prefer trading NASDAQ, but the ES is literally a mess. Like, there's nothing in here. I would not touch this. I would not do anything. You could be paying me to find setups in here, and I would be saying, no, don't touch it. It's literally asking to lose money by participating in this one, okay? NASDAQ isn't much better, but it's a little bit better, okay? So the same thing, I like these lows here for the first half of the year as a target. It's just overall, I think we're in heavy distribution. I think smart money is liquidating a lot of longs while it's being held here. And then eventually it's going to be probably event driven. And then boom, when war breaks out, we'll probably see the market start careening towards these levels here. And honestly, if the year has been in any indication of what the rest of the year is going to look like, I wouldn't be surprised if we just move and melt into the lows all throughout the summer down into the fall months and at the end of the year. There's nothing positive right now, folks. There's literally nothing positive. The economy is screwed. All the data we're getting is manipulated. It's coming to you late. I don't trust any of that data. And that's another reason why you're not seeing any new lifeblood coming in the marketplace. There's really nothing indicating trust. Nothing is being trusted right now. So risk with money behind it, it's on the sidelines right now, or working its way out of the marketplace where it can be preserved. All right, folks, that's it. Short, sweet, hopefully to the point for you. Just as a reminder, I am not on TikTok. I am not on Discord. I'm not on Facebook. I am not on Instagram. There's a lot of people out there pretending to be me, and you got to come to the source, and you can only get that from 2 places: my official YouTube channel, which you're watching this video on, and it's Inner Circle Trader, and my official X, or what we used to call Twitter, which I always actually call Twitter. That's my handle. There's a lot of fakes on X that try to change this around and make you look like I'm selling you a mentorship or I'm selling you some kind of a, you know, membership of something, and or crypto investment opportunities or any kind of scammy type thing like that. That's not me. I'm not asking for your money. I am writing books, but I'm also telling you don't buy them because it's all on this YouTube channel. It's just for people that want to have it in print form. Some people just simply want it like that. But it's also for me to simply codify it in text form from the horse's mouth himself. This is what it is. This is how it should be learned. And this is the textbook edition of the concepts. So until I talk to you tomorrow, Lord willing, be safe.